Hey, what's up guys? John here. I met with a private equity investor in New York a little while ago who raised just under $1 billion in cash to buy single family houses. And what he told me is it's just unbelievable. It's completely unbelievable. And I believe it, but I don't think the general public will believe it. When I asked him, what do you think about the economy? What do you think about these bankruptcies? What do you think about the real estate market, commercial loans? What do you think about everything that's going on with affordability, insurance? And I started asking him all these questions, hoping that he would supply me with insight from his peers and from his own source of wisdom, that he could share some value to me and then I could pass it along to you guys. But what he told me was unbelievable. Absolutely unbelievable. He said, John, when I founded this company many decades ago, I founded this company based on hiring a team around me of people that were smarter than myself in their own area. And I hired only based on skill set, execution, and that principle, right? Of course, ethics and everything else, but those were the premises of which I was hiring. And it just so happened that I hired a whole team of white people, right? Primarily white men were the ones that were applying and were getting the roles. And now with what's going on with the ESG, this is actually impacting us with raising money from insurance companies, pensions, and other large institutional investors which fund our transaction. Now he buys tons and tons and tons of single family homes. He's like, so it's actually harder. So not only are we dealing with this liquidity crisis with what's going on right now with banking, but we're also dealing with this other hurdle, which is the demographics of my team. And I said, so what advice would you have if you were to start or raise money today? And what he said was interesting. He said, if you hire a team of only white men, you're going to have a hard time succeeding because now everything is going to be leaning into ESG, everything. And so he's like, it comes down to you want to hire different races, you want to hire transgender, you want to hire all these different people based on being able to raise money. And I was like, that sounds absolutely crazy. Like you build a team based around your team's ability to supply value to the marketplace and you're paid based on that value, right? No, that's not how it's going to work. Look at what's going on right now, and I'm going to show you how this is all kind of playing out. Also, hit the like button if you want to share this content to educate more people. YouTube will share it. And today's video is sponsored by my company, GreatCreditFast.com. If you want to fix your credit so you can position yourself for the greatest wealth transfer of all time, it's going to be impossible to do it if you have horrible credit, even bad credit. You're going to need great credit to step forward into what we're stepping into. We'd love to help you and give you a free consultation. Go to GreatCreditFast.com, GreatCreditFast.com. Take a look at this. So corporate bankruptcies this year, the highest since 2010. Highest since 2010. And they go on to say, zoom out. For companies that weren't doing so hot before the rate hikes, the end of cheap money sealed their fate. When ultra easy access to funding dries up, the spigot shuts off. For companies that probably shouldn't be borrowing more anyway, the pace slowed after that. There are 54 bankruptcies filed in all of May, a slight uptick from the prior month, and lower than March when 70 companies filed, per the S&P's report. Well-known brands filed Chapter 11, Bank of America, Bed Bath & Beyond, Party City, and mattress maker Serta Simmons. Now, you look at companies such as Bank of America, Wells Fargo, Chase, you look at these other companies, these large banking institutions, what is going to happen? Well, I believe Janet Yellen gave us a hint yesterday when I shared this in yesterday's YouTube video. She said that these banks, these small banks, are going to start to consolidate. And consolidate in a very, very big way is where I think it's going. She said, we're going to start seeing more regionals consolidate, but I think it's actually going to be much, much more than how she's leading us on to believe. The reason for this is a couple things. They're going to keep interest rates higher for longer, most likely. They are likely going to continue to hike in the short term. There's going to be more pressure felt on these regional banks. As that begins to happen and consumers pull out deposits and these commercial loans and these other loans start to default at a much higher velocity, these banks aren't going to be able to hold on any longer. And so you're going to have these larger banking corporations step forward, gather market share, and then they're going to start implementing these ESG policies. So as that's happening, you have to ask yourself, is your business going to have a bad ESG score? Now, people are going to be like, oh no, screw that, it's not going to happen. Look at the last few years. The last few years, people did just let everything happen. So it's going to happen. Whether you like it, whether I like it, dislike it, our opinions are irrelevant. We look at what's going on. 10% of the world's money is already in this. 10% of the world's money. So to think that it's going back to 2018, 2019 and things are going to just go there, I don't think so. Again, I'm disregarding my opinion as a whole because one smart man said a quote that I'll never forget. He said, "Smart people see things for how they really are, and everyone else sees things for how they want them to be." This is how things really are. So like this, the future of green financing and sustainable banking is bright, with many opportunities for growth and innovation. As more investors and institutions recognize the importance of sustainability and ESG issues, we are likely to see a significant increase in demand for green financing and sustainable banking services. These banks are they're gonna start to do this. As they consolidate and we start to see a lot of these commercial loans get underwrote, a lot of these go back to the bank. These banks that start issuing these finances or the financing for future loans are going to start looking at who's on the board of directors on the company that wants to get that financing. What company is going to be working there? What is the impact on the environment? What is, they're going to start looking at everything. It actually kind of breaks down cleanly here, just so you kind of can get an idea of how this will play out. So it'll look kind of like that. Loan application data, then upfront ESG checks, then additional ESG checks, then evaluation of carbon intensity, then ESG risk assessment or decision, then monitoring. And again, this is from McKinsey, a multi-billion-dollar company. Carbon steering, carbon accounting, portfolio alignment, right? All this. So when you start to kind of ask yourself, what other stress tests, how they're going to do this, like everything is going to change, everything. And now, this isn't going to happen overnight. Now, I want to be very clear. This isn't going to be something where they're just going to like flip the switch and everything's going to be like that. No. But it's going to be a gradual progression to this. And smart and savvy investors are paying attention to the future. You make money by getting in front of the wave, right? You get in front of the wave. Now, the big question is like, how does this all play out? I think what we're going to start to see, Glenn Kelman actually gave us a really good example of this, the CEO of Redfin 2 years ago, when he said that insurance companies and actuaries are going to start repricing assets, and it's going to get much harder to get insurance. It's going to get much harder to get financing in certain parts of the country. Now, he wasn't talking primarily about ESG, but what he was talking about was along the environment sector, not the social governance, but along the environment. But all of that kind of plays out. So you have to start asking yourself what markets are going to offer less risk, what markets are going to offer more, which industries are going to be harder to get funding for and financing for, which ones are going to do better. Now, I think a huge market that's going to open up, I think it's going to be huge. It's probably going to be carbon credits. It's going to be solar. It's going to be anything green energy. Any of that stuff is going to have, I think, a windfall of capital is going to flow to it. But other industries, I think, are going to start to see more challenges for financing. I mean, and of course others such as automations, robotics, technology, all of these industries, everything is going to change when these big banks consolidate market share. That's point blank going to happen. There's actually, I think the odds of that not happening are basically zero. We're moving into that direction where we're going to start to see, JP Morgan Chase, for example, having 20% market share. Bank of America, having 25% market share. Wells Fargo, before you know it, it's just going to be like 6 banks, boom. They all have one underwriting standard. You either meet it or you don't. It's either good for the world or good for the environment, or it's not. Your team's either, someone that is equally accepting of all people, or it's the problem. That is it's a hard pill for me to even swallow, but if I just look at what is happening, that's kind of where it looks like to me. This data governance growing imperative for banks, a forward-looking ESG data and technology roadmap can help banks get ahead of growing regulatory and consumer demand and avoid technical debt. And the banking industry is facing a mounting pressure to meet fast-changing demands in environmental, social, and governance (ESG) issues. New and evolving regulations call for greater transparency, disclosure of ESG-related data, sidebar ESG regulatory and disclosure requirements. Stakeholders and investors are increasing their scrutiny of the effects of investment decisions on the climate and society. Consumers are holding banks to higher ESG standards as well. In 2019, about 14% of total client-driven revenues were controlled by consumers whose banking preferences were influenced by concerns about proposed insustainability. So again, I've removed my emotion from it. I look at what's going on. I think that we're stepping into, as I've mentioned on this channel before, the greatest wealth transfer of all time. You want to pay very, very close attention to the future. Pay attention to what's happening behind the scenes. Position yourself for it. I think that we have, probably 3 years. I think we're probably have 2-3 years, during this from now until 25, 26. People can make a lot of money. People are going to lose a lot of money, but people can also make a lot of money. But you definitely want to pay attention to these details to position yourself. You don't want to ignore it. You don't want to ignore the facts. Really look at these papers and kind of pay attention to it, because if you don't, it could be a really, really big mistake. What do you think about it? Drop it below, hit the like button, and I have a new podcast coming out. So every Friday I have a podcast. Every Friday on this channel I have a call-in show. We kind of did a test last week, so we're going to start doing the call-in show as well. We'll be able to talk about stuff like this. It'll be really cool. And then add me on Instagram for short form content and other content that I'm definitely not going to share here at This Is John Williams on Instagram. And then, greatcreditfast.com. If you need help fixing your credit, we'd love to help you. Greatcreditfast.com. Catch you guys in the next one.